Pakistan ended the last fiscal year with a current account deficit of $139 million, reversing the $1.84 billion surplus recorded a year earlier, according to new figures released by the State Bank of Pakistan. Despite the shift into the deficit, the overall shortfall remains relatively small, largely due to recorded remittance inflows, which helped offset pressures from a widening trade gap and rising imports. The State Bank said the current account recorded a $649 million deficit in June, compared with a $500 million surplus in May. In June 2025, Pakistan had posted a surplus of $220 million. During the fiscal year, overseas Pakistanis sent home $41.59 billion in remittances, up from $38.3 billion a year earlier, providing a crucial source of foreign exchange and helping contain the current account's deficit. However, the country's external position remains under pressure as imports continue to outpace exports. Pakistan recorded a trade deficit of more than $35.5 billion during the year. Good exports declined to $30.84 billion, down from $32.43 billion in the previous fiscal year. Although service exports increased to just over $10 billion, total export goods and services rose by $84 million, reaching $40.88 billion. The current account remained in deficit during 3 of the 4 quarters of the fiscal year. The first quarter recorded a deficit of $737 million, the second $624 million, and the fourth $425 million. Only the third quarter posted a surplus of $1.65 billion, helping keep the overall annual deficit relatively limited. Economists say the outlook of the current fiscal year remains uncertain following renewed conflict in the Gulf, which has pushed global oil prices higher. Pakistan imports around 70% of its fuel requirements, making the economy highly vulnerable to rising energy costs. Analysts warn if the conflict continues, the country's oil import bill could increase significantly, putting fresh pressure on foreign exchange reserves and the current account. When Pakistan benefited during the last fiscal year from lower oil prices and the temporary reopening of shipping through the Strait of Hormuz, those advantages could fade if regional tensions escalate further. Meanwhile, the State Bank also reported a sharp decline in foreign direct investment, or FDI. FDI fell 34% to $1.64 billion during the fiscal year, down from $2.48 billion a year earlier. China remained Pakistan's largest source of foreign investment, but Chinese inflows dropped $862 million compared with $1.21 billion in the previous year. Investment from Middle Eastern countries also declined, with analysts saying regional instability has further weakened prospects for attracting new foreign investment. For more, read the full Dawn story linked below.